Now, speaking of S&P 500, you've got traditional markets up there, and you've also got the Bitcoin, Ethereum market,
Yes.
just to show people that why we continue to cover traditional markets, and is that
Is
the
the
Bitcoin.
correlation, right?
Absolutely. And crypto is just another market in the economy at large. So, and it's really still just emerging. And as much as it's grown and as exciting and dynamic as it's been for many in crypto, it's still a baby when you look at the size and
For
scope
sure.
of financial markets and other sectors in
Well,
general.
we're not a technical analysis channel by any stretch. We're more in the fundamental analysis side of things, but we are, we do take a look at charts from time to time just to see kind of what's going on. And like as you mentioned, this is about showing kind of how the markets reacted to the news and then the correlation, right? How all these markets kind of move together. So that was the S&P. Here's the Dow Jones. Nasdaq is the same. That's the kind of the tech index. The Russell 2000, as well had the same movement down. And of course, the crypto markets reacted the same way. You've got Bitcoin here. We're looking at Bitcoin on the same day. Everything, follows the same trajectory. With Ethereum is the same thing. So
Mm-hmm.
this is just to make the point that, like you say, what's going on in crypto and what's going on in the traditional market are linked together. And it's and you can have decoupling. There are times when one project has some kind of launch or some new thing coming out or something really cool, exciting happen on a blockchain, and it might move against the trend. You're seeing that in the Cosmos IBC ecosystem. But as a whole, you can kind of look at the market cap of crypto and market cap of the S&P, and they will tend to track each other, right? And if you zoom out and you look at any one project, if you just look at the space, a day where there's a lot of red selling, a lot of red candles on the S&Ps, you're probably going to see a lot of red on the crypto indexes too. So having that relationship in mind, it can be very helpful.
Absolutely. And on the way out, another aspect that we've mentioned before, and we'll continue to mention, not this, I'll let you tackle this in a second, but I was going to say that we've been very clear that the crypto markets for quite some time have been heavily supported and integrated by the traditional markets. We on our channel, never have we alluded to this fantasy that the growth of blockchain and crypto has been from a grassroots open up your laptop and mine Bitcoin or mine crypto. That nostalgia wore off over a decade ago. The reality is that when you look at what drives the prices and the investment, BlackRock, Citadel, these large corporations, JP Morgan, I mean, there are major financial intermediaries and large players around the world that have been involved in Bitcoin and cryptocurrency in general. So, if you would like to understand the direction of the Bitcoin crypto market, it's really imperative to understand not just the new laws and the regulations that are being passed and how men and women are looking to integrate this new technology into their spheres of influence. Um, I guess I was going on a tangent there,
Yeah,
but
no, you're right. It's all the above. There's a lot that goes into it, and it's not just it's not just the hype on Twitter and or in crypto Discord. It's there.
right.
It's Main Street, Wall Street is it's bigger a big of as any impact on it.
There's a lot of hype. Many people hype up that blockchain and crypto is all this huge decentralized grassroots movement, which many aspects of it are and how the technology works. But when you look behind the curtain and you see how blockchain has been able to physically grow over the last several years, there's been large investment from major
Deep
companies that have
pockets,
allowed
right?
deep pockets and that continue to influence the direction that decentralized applications will be built and which blockchains will flourish.
Yeah.
So,
And I would say,
but
to put a finer point on it, the cost of capital in the traditional market has a lot to do with how those deep pockets are able to leverage themselves in crypto. And when the cost of capital goes up, the opportunity cost of having that money in crypto goes up, and some of that investment can come out. You can see what's hot money flows. Like if you think back
Right.
to the 90s, right, where money flew in and then flew out, and then and that can be a problem. That can be destabilizing. So it's just something to be mindful of. The cost of capital and what happens when it becomes expensive to borrow, and what happens to investment. And it's not complicated. It's just, the more expensive it is to borrow, the less borrowing there'll be, and the less credit there'll be, and the less credit there'll be, the lower prices will be, because it's just a function of money turning over and changing hands, and that's all it is. So it'll impact crypto just like any other market.
Absolutely. So you have price stickiness up, because we were going to mention, we've talked a little bit about it. We've danced around it without mentioning actual price stickiness, but how does this affect CPI data and inflation?
Yeah, well, so definitely. So what price stickiness is the tendency for prices to become kind of stuck, right? Which means that the traditional way to think about this is in a recession or a depressionary environment where there's losses are occurring, businesses are facing, revenues are falling, sales are falling, consumers are retrenching, and maybe stock markets are collapsed or selling off, and labor markets, there's not hiring going on, maybe there's layoffs going on. And the question is well, why don't all the laborers just agree to take a wage cut, and then why don't the retailers just mark the prices down a little bit, and so people can continue shopping? And why don't all these prices just adjust immediately, and you would never have idle resources, you'd never have inventories pile up, you'd never have unemployment, because everything would just frictionlessly adjust, right? And that's the ideal. But in reality, that's not how things work. There's this who goes first problem. Do I cut my prices before the other guy? So you get this game theory problem where you got like a prisoner's dilemma, where like what's socially rational, or what might be rational for everybody is not in the individual interest to do because of their narrow framework they're looking at. So what happens is that prices don't tend to fall very quickly. In reality, sales just don't happen, and our labor gets idled. And over time, these idled resources then put downward pressure on prices, and it happens all at once. You kind of get this massive move downward in prices, and then it finds a bottom, and then you can start having a new growth, a new growth cycle. And the same thing occurs in the other direction. So you can have prices sticky to the upwards, where instead of like there's money, maybe money's chasing, maybe there's a lot of money fluctuating in the system, and instead of raising prices to kind of offset that excess demand, companies just try to sell more units at the lower price, right? So or the opposite, prices go up and you get an inflationary story, and then they don't want to fall because people get stuck in that sticky prices towards the upside, right? Because you get the same problem. Why do I cut mine if they're not going to cut theirs? You get who goes first. So in all, price stickiness is this tendency for prices to not adjust to kind of to adjust in order to reconcile some imbalance, whether it's too much demand or too little. And so instead of the prices adjust, you get quantity adjustments, which means that you just get layoffs if you're talking about prices falling. So instead of the prices falling, you just have goods don't sell. The prices stay the same, but the inventories pile up. The labor gets idled. People can't get a job. And this is a problem with markets, and it's not ever going to be solved. It's part of human nature. And another way to think of it, and another element this shows up in, is in expectations, which is when people can come to expect prices to be low. Like this is a problem we had the last decade, for the Fed had in the last decade, where they tried to create inflation after the housing bubble collapsed in 2008, and they couldn't create inflation because the structural situation with the credit deleveraging and liquidity drying up, and they printed a bunch of money, injected it into the economy, but because of the way people's thoughts were and the way that the underlying fundamentals were, it was more of a deflationary scenario. So they were putting all the money in the economy, and it wasn't having any effect on the CPI or on inflation. And they did this for like a decade, and we could never get inflation to budge above 2%. And it's because expectations for deflation had become entrenched. And this is relevant because now the opposite problem has occurred. we've become entrenched. We have entrenched expectations for future inflation, and the Fed is now having to kind of overcome that, and it's going to take more and more credit contraction, higher rates, more balance sheet shrinking in order to overcome that expectation of inflation. So all in all, it's like the Fed's facing the inversion of the problem it had in the last decade of not enough inflation. Now we have too much, and in both directions, the expectations are working against what they're trying to get done with their policy. So it remains to be seen if it'll take a decade, like it did prior, to beat the inflation problem. You know, let's hope not. I'm not trying to put that into the universe, but it just the relationship between expectations and sticky prices and policy goals is something to keep in mind. And the more things get entrenched, the more policy will have to be bigger, harder, longer to do anything.
Well, we definitely could see ourselves in a long 10-year cycle of almost sideways movement. And what I mean is, in the past, the Fed's either been, we got to contract or we've got to print, and we could be in this dancing stage where they get to a point where, oh, okay, well, we can loosen up a little bit, but we're still having to manage this. And we don't know what we're going to be able to do next quarter. So it got to the point where everyone just expected the interest rate to stay low and to get lower, and not even think about it. And now we could be at a point for the next decade where there isn't that expectation that it's just going to be printing as usual. It could be, ooh, are they going to raise the rate again this month, or are we going to get 3 months of or 6 months of a reprieve? And we could go for quite a period of time where there's this active management and trying to get back in control of inflation in the economy. So
and you know what, with all the supply chain problems, I don't want to get into any long thing, but if the supply chain problems, the disruption in the supply chain, it continues, and it should, because I don't think the separation between the United States and China, that's not going to change. I don't believe anytime soon. I think we're seeing like a deglobalization kind of story in the next period play out. I don't think that's going to change. So we could see not just the monetary side pushing the inflation narrative and becoming a challenge for the Fed, to rein the money in, but also just the supply chains, the supply shock and the aggregate supply reduction that's going to happen as we deglobalize could also reinforce inflation. So just to go into to agree with you, this could be a long-term problem for more than one reason.
So with all that being said, we have long-term solutions. We are a channel of solutions as well. But right now, there's definitely the solution from the Fed's perspective is to continue raising rates and tightening monetary policy on all sides. And of course, you know where to go if you want to stay abreast of the latest developments with the Fed, the economy, the market, the long-term direction, short-term direction, and how that's going to impact and affect crypto. We also talk about what's going on in the crypto world. There are opportunities for those who have their wallets, their Web 3.0 wallets. We will show you how to do that. We walk you through tutorials, how to get involved in different communities, whether it's staking, providing liquidity, and what it means to join new communities through airdrops and receiving free crypto by being a supporter of different blockchains. We talk about it all. If you like that kind of stuff, subscribe, notification bell, and I believe we covered a lot more than we anticipated, but this is the kind of stuff we like to cover. So we'll continue to keep you abreast of the latest macroeconomic news and how that will impact you, your home, your family, the world at large, because we're really talking about like you said, the deglobalization. We're really talking about changes that are taking place that will be affecting people everywhere. Just like blockchain and crypto itself, you build relationships, this decentralized worldwide community, and what's taking place with the Fed And with trade and the economies around the world and crypto regulation, they're definitely all connected.
Yep. And we'll be on top of it. So like, subscribe, and until next time,
Have a beautiful day. Namaste, y'all.
adios.